Welcome to Reality Bites. Today, we have a look at some of the worst real estate deals in history. When we take a deeper dive into real estate deals, it's hard to imagine in early man's past that there was some dodgy deal done over a cave. But, if we learn anything from today's video, you can bet there were clubs at dawn in a few places. It's difficult to determine the absolute oldest real estate deal on record, as there are likely many ancient real estate transactions that have been lost to history. However, one of the oldest recorded real estate transactions is known as the Agreement of Naram-Sin. It dates back to around 2300 BCE, and records the sale of a piece of land in the Sumerian city of Nippur in what is now modern-day Iraq. The ancient Sumerian city of Nippur has a history dating back 4,000 years. The transaction was recorded on a clay tablet and included the sale of a field and a house for a price of 6 shekels of silver. The tablet also included the names of the buyer, the seller, and the witnesses to the transaction. This shows that real estate transactions have been taking place for thousands of years and have been an important part of human society throughout history. Another early real estate deal tablet showing a real estate deal is the Sumerian King List, which dates back to around 2100 BCE. Although the Sumerian King List is primarily a historical document listing the names of Sumerian kings and their reigns, it includes a section that records the sale of land by a king named Enmatina to a man named Kiksi in the city of Lagash. The tablet does not provide much detail about the transaction, but it does mention the amount of barley that was paid for the land. While the Sumerian King List is not solely focused on recording real estate deals, it is the earliest known example of such a transaction being recorded in writing. Now, we have no idea if these were fair deals. But taking a closer look at Enmatina, the Sumerian king, who ruled over the city-state of Lagash in southern Mesopotamia during the early dynastic period around 2400 BCE. I think you will find he was a cool king. He was known for his legal reforms and his efforts to improve the welfare of his people. Enmatina is credited with introducing a new legal code known as the Laws of Enmatina, which sought to regulate various aspects of society, including property rights, family law, and commerce. This legal code is one of the earliest known examples of a written legal system and is considered a significant achievement of early Mesopotamian civilization. In addition to his legal reforms, Enmatina is also known for his building projects, including the construction of temples and other public works. He was succeeded by his son, Entemena, who continued his father's policies and expanded the power of Lagash. I am going to guess Kiksi got a sweet deal. Not so sweet are the following worst real estate deals in history. Let's start with the Mississippi Bubble, 1716 to 1720. This was a speculative real estate investment scheme in France that led to a financial collapse. The French government gave the Mississippi Company, led by Scottish financier John Law, a monopoly on trade with Louisiana and Canada, and Law created a stock market bubble by hyping the potential profits from trading in the region. One of the reasons that the scheme was so successful initially was because of the potential for profits in Louisiana, which was part of the company's trading territory. The Mississippi Company was granted exclusive trading rights in Louisiana, which was known for its fertile land and valuable resources, including timber and fur. The company also promoted the idea of settling Louisiana and developing its natural resources, which would have involved the acquisition and development of real estate. The exact amount of money lost during the Mississippi Bubble is difficult to determine, but it is estimated that the losses were substantial. At its peak, the Mississippi Company had a market capitalization that exceeded the total value of all the gold and silver in France. According to some estimates, the total losses suffered by investors may have been as high as 10 billion livres, which was a significant amount of money at the time. 10 billion livres in 1720 would be equivalent to approximately 13.2 billion euros today. When the bubble burst, investors lost their money and the French economy suffered a severe recession. Next we move to Florida. In what was called the Florida land boom. It began in earnest in 1921 and continued until the collapse of the stock market in 1929, which triggered the Great Depression. During this time, people from all over the country were drawn to Florida by the promise of warm weather, beautiful beaches, and opportunities for real estate investment. The boom was fueled in part by the growth of new industries, such as tourism and agriculture, as well as the availability of easy credit. Many people saw Florida as a place where they could make a quick profit by buying and selling land, often without even seeing the property they were buying. As a result of this speculation, land prices skyrocketed, sometimes increasing by as much as 1,000% in a matter of months. Some developers engaged in unscrupulous practices, such as selling land that was underwater or that had no access to roads or utilities. The boom came to an abrupt end in 1926, when a devastating hurricane hit Miami, causing widespread destruction and loss of life. Many investors, who had overextended themselves, were unable to recover from the financial losses they suffered as a result of the storm. Then in 1929, the stock market crash triggered the Great Depression, which brought the Florida land boom to a definitive end. It is difficult to single out one person as the worst, as there were many individuals and companies involved in unscrupulous practices and financial manipulation. One notable figure during the Florida land boom was Carl Graham Fisher, a prominent entrepreneur and developer who was instrumental in the development of Miami Beach. Fisher was known for his extravagant lifestyle and his aggressive marketing tactics, which included advertising campaigns that exaggerated the potential of Florida real estate and drew in investors from all over the country. It is hard to determine exactly how much money was lost, as the boom was characterized by a lack of transparency and regulation, and many transactions were not properly documented. However, it is estimated that billions of dollars were lost by investors and speculators during this time. One of the major factors contributing to the financial losses was the practice of buying land on margin, which allowed investors to purchase large amounts of property with only a small down payment. When land values began to decline, many investors were unable to meet their margin calls, which led to widespread bankruptcies and foreclosures. In addition to these individual losses, the collapse of the Florida real estate market had a broader impact on the economy, leading to a decline in the construction industry and a loss of jobs. Many banks and financial institutions also failed as a result of the financial losses they incurred during the boom. If that's not a lesson learned, well, plot shocker, it wasn't.
What?
Let's move to the other side of the world. The Tokyo real estate bubble, 1980s. Also known as the Japanese asset price bubble, was a period of rapid inflation of real estate and stock prices in Japan that began in the mid-1980s and peaked in 1991. The bubble was fueled by easy credit, low interest rates, and a speculative frenzy among investors. During this time, land prices in Tokyo and other major cities skyrocketed, with some areas commanding prices that were more than 10 times higher than in other major global cities. Investors, both domestic and foreign, poured money into Japanese real estate and stocks, driving prices even higher. However, the bubble eventually burst in the early 1990s, leading to a protracted period of economic stagnation known as the lost decade or the lost score in Japan. Real estate prices crashed, stock prices plummeted, and many investors were left with huge losses. The Japanese government was forced to step in with massive stimulus measures to prevent a complete economic collapse. The legacy of the Tokyo real estate bubble can still be felt in Japan today, with many areas of Tokyo and other cities still struggling to recover from the overinvestment and overspeculation of the bubble years. The bubble also contributed to a shift in the global economy, as Japan's economic dominance in the 1980s gave way to the rise of other Asian economies in the 1990s and beyond. As in the past, it is difficult to determine exactly how much money was lost during the Tokyo real estate bubble, as the bubble was characterized by a lack of transparency and regulation, and many transactions were not properly documented. Sounds familiar?
Yeah.
It is estimated that the total value of real estate and stocks in Japan at the peak of the bubble was worth more than the entire US GDP at the time. Now that was a whopping $6.158 trillion back in 1991. It is estimated that Japanese banks alone lost more than $1 trillion in bad loans as a result of the bubble. The ensuing period of economic stagnation had a ripple effect on the global economy. Many businesses failed, unemployment rose, and Japan's position as a global economic superpower was weakened. There were many people involved in the Tokyo real estate bubble, including investors, bankers, politicians, and regulators. Some of the key players in the bubble and its aftermath include real estate developers. Many of Japan's largest and most powerful real estate developers were instrumental in driving up property prices during the bubble years. These developers included companies like Mitsubishi Estate, Mitsui Fudosan, and Sumitomo Realty. Banks. Japanese banks played a major role in fueling the bubble by providing easy credit and loans to real estate developers and investors. When the bubble burst, many of these loans went bad, leading to widespread losses and bankruptcies. Some of the biggest banks involved in the bubble included the Bank of Japan, Mitsubishi Bank, and Sumitomo Bank. Politicians. The Japanese government at the time was heavily involved in promoting economic growth and development, and many politicians supported policies that encouraged real estate and stock market speculation. Some politicians were also accused of accepting bribes and kickbacks from real estate developers and other industry players. Regulators. Regulators in Japan at the time were criticized for their lax oversight of the financial industry, which allowed speculation and risky investments to flourish. The Ministry of Finance, in particular, has been criticized for failing to properly regulate banks and financial institutions. Ordinary investors. Many ordinary Japanese citizens were caught up in the speculative frenzy of the bubble years, investing heavily in real estate and stocks in the hope of making a quick profit. When the bubble burst, many of these investors were left with huge losses and debt. Overall, the Tokyo real estate bubble was a complex and multifaceted phenomenon that involved many different people and institutions. Its legacy continues to be felt in Japan today, as the country grapples with the long-term economic and social consequences of the bubble years. By now you might be wondering, is there anything that does not end in world collapse? Well, surely with four-leaf clovers, and the luck of the Irish, there may be a more happy tale. I am sad to say, not in this documentary. One of the most notable real estate deals that is often regarded as a significant misstep is the acquisition of the Irish glass bottle site in Dublin. In 2006, a consortium which included Bernard McNamara, developer Derek Quinlan, and several others, formed Beck Bay Limited to facilitate the purchase. Beck Bay was a special-purpose vehicle set up specifically for acquiring the site for €412 million. The glass bottle site, located in Ringsend on the banks of the River Liffey, spanned approximately 25 acres and was highly sought due to its potential for redevelopment. The Irish glass bottle site was originally owned by Irish Glass Bottle Factory Limited, which had a long history, dating back to the 19th century, and was known for producing glass bottles for various industries. The consortium had ambitious plans for the site, envisioning a large-scale mixed-use development. The project aimed to include residential units, commercial spaces, retail outlets, leisure facilities, and public amenities. Unfortunately, the timing of the purchase coincided with the global financial crisis and the subsequent collapse of the Irish property market. Property prices plummeted, credit became scarce, and the demand for new developments diminished significantly. Due to financial constraints, the Irish glass bottle site remained largely undeveloped for years. The consortium was unable to move forward with the initial ambitious plans, and the site became an emblematic symbol of the property market collapse in Ireland. In 2012, McNamara's construction firm went into receivership, a process in which a receiver takes control of a company's assets to repay outstanding debts. The collapse of his business and financial troubles garnered considerable attention in Ireland, symbolizing the challenges faced by the property sector during the crisis. In 2018, the Irish government intervened and acquired the site for €45 million. The significantly reduced purchase price reflected the sharp decline in property values since the initial acquisition. The government's intention was to redevelop the site for much-needed housing and other community purposes. Last year, a consortium of Ronan Group Real Estate, Oaktree Capital Management, and Linker Developments was chosen as the preferred bidder to develop up to 3,800 apartments on the former industrial lands on the Irish glass bottle site. It was reported at the time that the winning bid for the controlling interest came to a higher-than-expected €200 million. So, I expect the Johnny Ronan-led consortium will be in one of our future episodes as yet another housing crash is on the horizon. The luck of the Irish sort of worked out, the government did quite well out of it in the end. Bad real estate investments can be valuable learning experiences that provide insights and lessons for future investments. Shame the people and investors in this video did not subscribe to this channel. What lessons can be learned from today's dive into madness? Bring a ladder to an open house? Most of today's smaller investors thought it was a high-yield investment. Bad jokes aside, here are some key lessons that can be learned from such experiences. This is not financial advice, just some great real estate tips. Thorough due diligence. Analyze market conditions, property values, potential risks, and financial feasibility. Financial prudence. Avoid over-leveraging and ensure you have sufficient reserves for unexpected expenses or market downturns. Diversification. Diversification helps minimize the impact of a single bad decision on your overall portfolio. Market timing. Understand the cyclical nature of real estate markets. Avoid being swayed by speculative trends or herd mentality. Risk management. Implement risk mitigation strategies such as insurance, contingency plans, or alternative exit strategies. Learning from mistakes. Reflect on the bad decisions you have seen today and analyze the factors that led to the undesirable outcomes. Apply these lessons to future opportunities. By learning from these mistakes, you can improve your decision-making and increase the chances of successful real estate ventures.